Welcome back, everybody. I am Ganesh Narvade, and today we are discussing the second lecture on basic concepts. Now, understand that if you want to really clear CMA Inter, for that, tax is the most crucial subject because all the three subjects are single subjects. But this taxation is direct tax is an independent and indirect tax is an independent subject. So it is double two subjects. And moreover, this subject is the only subject where huge amendments come. Law also there are some amendments, but tax has huge amendments. And it is conceptual and numerical both. Suppose you take costing, more numerical, very less concepts. When you take law, complete concept oriented. When you take accounts, complete numerical, very less concept. But here, both are equally important for you. And that's why don't ignore this subject. Be very committed to preparing this subject in advance. Last moment, you will not be able to handle it. Okay. So come on, be on your toes. Every day, 3 hours of commitment. If you give, in 70 days, we can complete our preparation. So what we were doing in the last class, we discussed about something called as direct tax and indirect tax. We discussed about constitutional validity of taxation. We discussed about what are the sources of direct tax law. We discussed all these things. Along with that, who is person, who is assessee, what is assessment year, what is previous year. So many concepts we did. If you have not watched that video, you can go back and watch that video and then come to this video. Now, today I said that direct tax has only one tax, and that is income tax. In the last class, I said tax is a compulsory contribution. As a part of your income, you pay income tax, or when you purchase some goods or take some services, along with the price, you pay some amount. That is tax. We discussed direct and indirect, two different types of taxes. Direct tax, income we have to understand because income tax is the only direct tax today. Question to all of you. We discussed tax, but did we discuss income? Are you curious to know? Let us discuss today. So what is income? Income is given in section 2, clause 24 of the Income Tax Act. Now, you may be thinking, why should I use clause word? I should use section also, correct? So I'll tell you that whenever in a section some sub numbers are given and all are connected to each other, all talk about the same thing in a sequential way, then we use the word subsection. If every subpart is an independent concept, then we use the word clause. So section 2 actually talks about definitions, and definitions all independent meanings of each word. So that's why in section 2 we always use the word clause. It's not just in income tax, whether it is Companies Act, whether it is Contract Act, whether it is GST, whether it is any law in India. Section 2 is definitions, and definitions, if you see subpart, it is clause. Okay. So income is given in which section? Section 2, clause 24. Now the technical definition which is given is very huge, very big, and it covers all the chapters which we are going to discuss in income tax. Like you earn income through salary, right? You do a job, you get salary, that is your income. You give property on rent, you earn rental income from house property. You do business, you earn profit, that is also income. You set up your own office as a CMA, right? And when you set up your own office, we call it as profession, and you get fees from your client. So that is also obviously income. You sell property, you sell shares, you earn income, that is capital gains income. And finally, you earn many other incomes, like you may be earning something called as lottery income. From online games you can earn income, but please avoid that. Lottery also you avoid, right? You deposit money into bank, you get interest. You purchase the shares of the company, you get dividend income. So like that, they gave complete list of all the incomes in section 2 clause 24. Technically it is difficult for you to understand and exam wise not at all useful. So that's why we will discuss more of a analytical part, critical analysis we'll do of all that things are given, so that you understand the crux, which will help you to understand further chapters. Okay. Now, first point. When I say income, you can receive income in cash or you can receive income in kind. Correct? So in cash, how you receive, I'll tell you. You do job, you get salary. So now, when you get salary, your employer may give you cash or your employer may transfer the money to your bank account. So if you receive in bank account or you receive in cash, here we are treating it as cash only. So income can be in cash or income can be in monetary terms. Correct? Sometimes the income can be in kind also. Kind means you will get some goods, you will get some assets, you will get some gift. Like example, you participated in a contest and you won 1 kg gold as gift. Okay. You won the award and it gave you 1 kg gold. Now, income tax cannot ask you that, okay, you deposit 300 grams gold with income tax department. They cannot ask you like that, correct? So what they do is they'll ask you to value the gold. So if you don't know, I'll tell you, there are proper rules for valuation of jewelry, for valuation of shares, for valuation of land, valuation of building. Like that, certain assets are there where income tax has proper rules of valuation. Follow the rules, value it in monetary terms, and your income is done, decided. But there may be some assets whose value cannot be determined. Like example, you participated in a concept or competition and you won Samsung S25 Ultra. So when you won that phone, what is the value of it? There is no valuation rules for it. So we have to see what is the fair market value of the phone. We'll go to the official website of Samsung, see what is the price, and that is the value. That is the income which you earned. So clear? Income can be in cash, income can be in kind. This way you understood. Okay. Second, how to compute the income? For that, method of accounting is important. So there are actually 5 heads of income which I'll teach just after this. Okay. 5 heads of income are there. Like I just explained to you that when you do job, you get salary, that is salary head. You rent a property and earn rental income, that is income from house property. Third one is when you do business or profession, it is profits and gains of business or profession. Fourth one, when you sell a capital asset, when you sell the shares, you get capital gain income. And when any other income comes, we call it as income from other sources. So these are basically 5 heads which I have to tell. Now, when it comes to salary income, house property income, or capital gain income, your method of accounting is irrelevant. So salary income, house property income, and capital gain income, method of accounting is useless. But when it comes to your profits and gains of business and profession, when it comes to income from other sources, these two heads are there. What are they? Tell me, repeat with me. Profits and gains of business or profession. Second one, income from other sources. What method of accounting you follow is very, very important. Let me tell you, we have two methods of accounting. One is cash basis of accounting. One is accrual basis of accounting. You know what is cash basis? Right? Cash receipt comes, you will record as receipt. When you pay, you record it as payment. You don't calculate income or all that. Paisa aaya, paisa gaya. Cash received, cash paid. That's it. So if you follow this accounting in your accounting records, when you prepare books of accounts, then definitely in income tax also we can follow cash basis for computing your business income, professional income and other sources income. But suppose if you follow accrual basis of accounting, that means the income may be received or the income may be accrued. We will record it. Income may be received or income may be accrued. We will definitely record it. This is accrual basis of accounting. Okay. Due basis of accounting. Mercantile basis of accounting. We remember? In accounts you write outstanding salaries, outstanding rent. Why we write? Because it is rent to be paid. So it is an expenditure pertaining to this year. So like that when you record, we call it as mercantile basis of accounting. We call it as accrual accounting. We call it as due basis of accounting. And suppose in accounts you are following that. In income tax also you follow the same. But only for two heads. What are they? Profits and gains of business or profession. And second one, income from other sources. Okay. This way you should remember. So in accounts, there are two methods, cash basis of accounting, mercantile basis of accounting. And whatever you follow in your accounting practice, same you follow in income computation, in income tax also. Very good. Now let's go to the third point. But let me recap for second point. What they said, there are 5 heads of income, income from salary, income from house property, income from capital gain, I said. For these 3, method of accounting not at all relevant. For profits and gains of business or profession, income from other sources, your method of accounting, whatever you follow in accounts, same has to be followed in computing the income under income tax. Right. Now, notional income is the third thing to teach. What is notional income? Notional income is, I can say in accounting language, your departmental profit. What happens? One department supplies some material to another department. Now, to show that department is performing well, you have to show departmental profit in your accounts. But is it your real profit? The answer is no, because you did not earn it. It is just within your organization. Suppose you have 1000 rupees, you kept in one pocket. Now you shifted that money to another pocket. Doesn't mean that your income is generated, correct? So departmental profit is good for accounting. But in income tax, the profit which is not earned from outsiders is not at all your income. So notional income is not an income under income tax. Of course, there are some exceptions. I'll tell you when that respective chapter comes. But in income tax, notional income is not an income. Okay? This general rule we'll remember here. Exception I'll teach in house property chapter. Okay? Let's continue with the fourth one. Source of income. Now you can have multiple sources of income, correct? Suppose I am a teacher. I want to earn income by recording classes, taking face-to-face classes, by writing books, by writing research articles on taxation, by giving lectures in conferences, by taking different workshops, by taking faculty development programs, right? So many things actually. I am a YouTube influencer also, correct? So I can also generate income through YouTube ads. So many things I can do to earn income. All are sources of income. So sources cannot be one. Sources can be many. Suppose I have 3 house properties and each property I am giving on rent and earning income. So the rental income from house properties are different sources. House 1 is a different source. House 2 is a different source. House 3 is a different source. So sources can be multiple. Now, next concept very critical. And many students get confused also. But don't worry. I am here to make things easy for you, correct? That confidence you should have and just focus on what I say. Right? Capital versus revenue. Fundamentally, most important topic for whole income tax subject. Okay? Let me tell you one rule for revenue receipts and repeat with me. Remember, right? Here you should remember. Very strong memory you should create. Generally, any revenue receipt is taxable. So generally, revenue receipts are taxable. So if you are doing a business, you sell products, you get money. It is a revenue receipt. It is a recurring receipt. So generally, revenue receipts are taxable. But suppose income tax department says that this particular revenue is not taxable, then it is not taxable. That's it. So let me tell you in simple language. They were generally revenue receipts. Yani whatever business transactions happen, and in that business transactions, you get some fees, you get some sales revenue. That is generally taxable. But income tax says if it is a revenue of an agriculture business, right? A farmer's doing farming and selling his produce and earning income, it is not taxable. Suppose you think about Godrej Farming is a company. In Godrej Farming, they do a lot of agricultural activity, sell organic products and earn income. For them, their income is not taxable. It is revenue only, correct? But it is exempt. It is not taxable because it is specifically mentioned in the income tax. So what I want to tell you, generally revenue receipts are taxable. But if income tax department explicitly tells that this is not taxable, this is exempt, then it is exempt. Generally, every revenue receipt is taxable. But income tax said that, okay, farmer's income not taxable. They say that suppose a government organization is there, their income is not taxable. Or suppose let's assume religious organization is there, they earn some money through donations, it is not taxable, they said. So okay, generally revenue receipts are taxable, but specifically if explicitly government tells, income tax department tells this revenue receipt is not taxable, then it is not taxable. That's it, we should remember. So when you solve the problems also in income tax, what will you see? Is it a revenue receipt? Yes. So you will say it is taxable. But then you will also search for provisions that is there any exemption here? Is there any section in income tax which says here this revenue receipt is not taxable? Then if such section is there, if such provision is there, then obviously that particular revenue receipt is not taxable. That particular nature's revenue receipt are not taxable. Okay. So I gave general example also, like sales I said, fees I said, correct? When you render some service, your service charges may be there. So these are revenue receipts. Routine, they are taxable. Exceptions, I said agriculture, charitable donations, not taxable, right? Okay. And these not taxable are specifically mentioned in income tax. Please remember. Okay. This is all about revenue receipts. And now I'll talk about capital receipts. And when I talk about capital receipts, it is exactly the opposite of revenue. देखो, capital receipt can be like you took a loan. Now, loan when you took, it is a capital receipt for you, correct? Or suppose you started a company, you issued the shares, and people subscribed to your shares. Yeah, people purchased your shares, right? When people purchased your shares, subscribed your shares, they paid you money. Now that is also a big receipt, correct? So generally capital receipts are there. These are called as capital receipts. Are they taxable? The answer is no. So general rule is capital receipts are not taxable. But when I say general rule, automatically next exception will come. Like that you should think. Okay. So exception is that if it is specifically mentioned in income tax that this capital receipt is taxable, then it is taxable. Okay. In capital, what is the rule? Generally, capital receipts are not taxable. Like I gave loan example, capital example. These are capital receipts. They are not taxable. But let me tell exceptions. Like you sold a property. It is taxable under section 45. When you sell shares, it is taxable under section 45. So if it is specifically mentioned that it is taxable, then it is taxable. So did you understand the difference between revenue and capital? Yes, exactly opposite. Revenue, generally all revenue receipts are taxable. If specifically exempt, specifically said not taxable in income tax, then not taxable. Capital, generally all capital receipts not taxable, but if in income tax specifically mentioned, then only that specific items are taxable. That specific items of capital receipt are taxable. Now, let's go to the next part. So, are you able to understanding the depth? Because it's not just gas, like I'm just telling you something on the lighter note and completing the syllabus. I am going to give you the depth of the concepts, right? So that you should be able to handle the exams with supreme confidence. And when you go to the practical world also, you should have your strength to talk on the provisions. And that's what I'm going to build in you. Okay, let's come to the loss part. Now, loss. Dekho, when income is taxable, then loss is also to be considered, correct? Dekho, when somebody earns income, government says, I'll tax. So somebody gets loss, that loss should be allowed to be deducted from income, correct? In P&L account, what we do? We credit all the incomes, correct? Automatically, one more thing we'll do is debit all the expenses and losses. So that's what income tax also says. That income should be considered, loss should also be considered as negative income. Okay? Very good. Now, disputed income. Suppose if it is a disputed income, there is a fighting between people on some property. Now, if there is an income which is disputed, will income tax department say that, oh, it's a disputed income, let us leave it, let us not tax it? Income tax will not say, let your dispute continue. First, pay tax to us. Okay? Suppose example, there is a dispute between two people, suppose X and Y on the property and the income of the property. Then government will simply say, wait, who is receiving the rent? Sir, X is receiving. Okay. X, first include it in your income and pay tax to us. Let your dispute continue in the court. When it is solved, let's see. But as of now, you received the rent, correct? You pay the tax to us. If suppose later on the dispute is resolved, and Y becomes the owner, then income tax department says no problem. We'll refund the tax paid to X and collect it from Y. No problem at all. But if the income is disputed, doesn't mean the tax authorities will stop collecting tax from you. They will collect. Okay. Now, income may be received in lump sum also. Sometimes the income is received in lump sum. Sometimes it is a revenue receipt, recurringly received. Like if I do a job, for me, the salary income is recurring. Every month I get. But suppose I sell a property, I'll get one time payment only. Na? Are you able to understand? So, your income can be lump sum, your income can be recurring. Okay? Very good. Now, suppose I am filing GST returns of my client. When I am filing GST returns of my client, I am filing GST returns of my client. At that time, I have to pay GST on behalf of client. Client said, Ganeshji, you just make the payment, no problem. I'll reimburse to you. So I made the GST payment of the client to the portal, to the GST portal. And later on, client reimbursed. Tell me, when the client paid that money, is it my income? The answer is no. Why it is not my income? Because I did not earn it. Whatever I spent for the client, I got the same from the client. So there is no income generated. So reimbursement is not an income. When he pays the fees for my service, that is income. But when he pays whatever I paid on his behalf, that is not income. Okay? It is reimbursement, not taxable. Okay? Now, income may be legal, income may be illegal. Income tax don't have anything to do. Income tax is perfectly fine. First, let us collect the tax. There are many drug dealers who earn income. When income tax department raid their premises, they catch hold of all that cash, which is obviously illegally earned. Income tax will collect its tax first and then hand over these idiots, these destroyers of humanity, to the Narcotics Control Bureau. And these people will never come out of jail. They'll be punished. And you would have recently heard Donald Trump saying that we treat drug suppliers to be equal to terrorists. They should be bombed. They should be killed because they are destroyers of humanity. Right? Any of your friends who may be affected by drugs or may be thinking of consuming drugs, warn him, threaten him that no, never get into bad habits. Be very strict, be very disciplined. No alcohol, no drugs, no jarda, no tambaku. Right? Let us live a simple, happy life. So what we discussed? We discussed about legality. If the income is legal, illegal, in both the cases, the income is taxed by income tax authorities, and if it is illegal income, they will be handed over to the respective police, respective authorities. Okay. Now, can a single income be taxed twice? Can there be double taxation? The answer is no. If an income is taxed once, it cannot be taxed again. So there is a fundamental principle of income tax. An income is taxed only once. Okay, very good. Now, double taxation clear to all of you. Next thing, income by way of mutual activity. What do you understand by this? Dekho, there are around 20 friends. They all contribute money to a common fund and they accumulate the money. Whenever a friend requires, they give it to him. And like that, they help each other. Suppose during the whole process, if some surplus is generated, some additional income is generated, they again distribute among themselves. Now, when there is a concept of mutuality, mutuality means we are all one, we are not different, then such fund income is not taxed. Income by way of mutual activity is not taxed. You would have heard about self-help groups created in different rural areas by the government. Their income is not taxed because it is created by way of mutual activity, right? But suppose there are some exceptions to it also. Like example, our CMA Institute, Institute of Cost and Works Accountants of India. After you qualify the exam, you become a member of the institute. And when you become the member, you have to pay yearly fees to the institute. When you are a student, you pay fees at foundation, inter, final, at the time of articleship, at the time of placement training, at the time of exams, always. But after qualifying, you pay to the institute every year annual membership fees. Not only that, you attend professional development programs, which is compulsory again. There also you will pay the fees. So the collection of fees by the institute started from you. It will continue till your lifetime. Okay. And whatever the institute is collecting from its members, right? The membership fees, the professional development program fees, all that is taxable to the CMA Institute or even to the CA Institute, even to the CS Institute or any trade or professional organization. I gave lot of examples of professional, correct? I'll give trade examples also. Like Federation of Indian Chambers of Commerce and Industry, Confederation of Indian Industries is there, Ashocham is there. These are all trade organizations. Okay. CACS, CMA Institute, professional organizations. So if they earn any fees from the members, then it is taxable, right? Next, any group insurance by insurance cooperative societies or group banking. So banks earn something, insurance companies earn something through mutual activity, or the insurance organization is created for mutual benefit. The organization earns anything, it's taxable. So any income earned by trade professional organization or by a mutual insurance company or by a mutual banking company, even though they may say that we are one, we are not different, still the association's income, the institution's income is taxable. Only these three exceptions. Okay, right. So once you qualify CMA, obviously you will get married, you will get a job, right? So when you when you marry early or little late, whatever your case may be, you have to pay monthly maintenance to your wife. Hey, I'm just giving the examples of boys today. There may be a lot of girls listening to my classes. Don't worry. So when husbands pay monthly maintenance to wives or pay some pin money, we can use the word, for household expenditure. In that case, whatever husband pays to wife, it is not taxable. Why, sir? Because already husband earned income, on that he paid income tax. Na? Again, when he pays to wife, wife should pay. So wife will not have to pay any tax on the pin money, which she gets from husband for household expenditure. But one thing, Wife is super smart. She saves lot of money. She invests into some shares and earns income, or she lends it to somebody and earns interest income, or she does business out of it and earns profit. And there are so many smart ladies, right? And these ladies, when they earn income, this income is taxable. So pin money is not taxable. But if they generate revenue out of that pin money, it is taxable. There are two different types of personalities. One who believe in savings and investment, and the second who believe in lavish lifestyle. So those who believe in savings and investment and simplicity, they grow in life, they are peaceful, they are the most happiest one. And those who believe in fancy lifestyle, right, in luxury lifestyle, they ultimately end up in stress, anxiety, continuous disputes and all. Try to observe. If you are super rich and out of that richness you spend a little, that's okay. If suppose Ambani spent 1,000 crores on his son's marriage, out of 2 lakh crores, 1,000 is peanuts for him, correct? And out of all the PR, they would have definitely increased the sales and they would have earned the revenue. So be smart, be simple, save, invest, grow, and live a peaceful life. Okay, chal. Pin money you understood. So husband giving monthly maintenance to wife, that is not taxable to wife. And if she invests, do some business, earn some dividend, earn some interest, that is taxable. Then embezzlement is there. Some people embezzle the cash. That means steal the cash. So legal income, illegal income, both are taxable. So embezzled income is also taxable. But obviously, the person who embezzles will be caught by police later on, have to suffer jail, punishments and all. The law should become much stricter with the people who do wrong. Right? As of now, it is soft. Right? So embezzlement we understood. Now awards. Suppose example, you would have heard last year Paralympics happened and more than 20 medals disabled people earned for our country. Now suppose somebody won medal in shooting. Now a disabled person tells his family that I'll go shoot and earn. People would have shouted on him. People would have made mockery. But 27 medals which normal people could have not earned, so much medals in Paralympics, India got, right, in 2024, I am telling. So now, these people who participated in Olympics, they are professionals and their income is taxable under business and profession chapter. Okay, right? Clear? Very good. Suppose I go and play cricket and earn some income. Cricket is not my passion, not my profession, correct? So even if I earn something, it is casual income from me. It is taxable under other sources chapter. Are you able to understand? Right? Teaching is my profession. Cricket is casual income for me. Other sources chapter. Right? For a professional sportsman, like you would have seen so many sportsmen like Mirabai Chanu is there. Right? You would have seen this Paralympics. So many Olympians, right, who are disabled, they earned. You would have heard about Neeraj Chopra, right, recently married to somebody, right? So you understood that these people earn income. It is basically a professional income, right? If they give some conference, they give some lectures, for them it is income from other sources. Okay, like that. Now, we should understand that there is another word called as contingent income. Income which is doubtful, which may come, which may not come. Such incomes are not incomes. Suppose there is a dispute relating to some income, right? It is in the court. You may get the money, you may not get the money, right? In that case, it is not taxable, right? Huh. If the income is generated, but who is the owner is not known, then who got it will be taxed. That we discussed in disputed one. But here in contingent income, the income is not generated, Baba. Very good. Now, let's understand subsidy now. Subsidy means government giving you some support. China gives lot of support to their companies. India is slowly developing in supporting their organizations, their own companies. I'll tell you how much America supports Twitter. That's why Twitter is very famous across the globe, correct? One competitor like Ku from India emerged. He tried to take the space, but what happened? Our government did not support much. Who has to perish? So always remember one lesson in life, that if somebody is our person, we have to support them with strength and might. Like we are all CMA professionals. If some CMA want to grow, let us support him a lot. Right? Let's understand subsidy. So government gives lot of subsidy to some businesses, like electric vehicle industry is there, right? Green hydrogen business is there. The semiconductor chip type of industries are there. Defense is an industry today. Aviation sector is one industry, right? Space technology is one industry. Here government is giving huge subsidy to organizations. So subsidy is some cash support, or maybe some support in kind, maybe giving some land to the businessman for free, right? Like you would have heard, in Gujarat, Mundra port was given to Adani. When it was given, acres and acres of land around the sea was given, just for 1 rupee per acre. So this type of support is by kind, and sometimes they give cash also. Now you may think government is favoring Adani. Actually, government favors every businessman who is a promising one. You develop yourself such business, become such businessman, government will definitely support you. And why Adani was supported? Because that land was so barren, that has to be developed into a port to become a logistical support system for our country. And he delivered the promise he made to the government. And that's why government supports him a lot. Right? Let's understand. So government may give you subsidy. Some cash incentive may be given. Sometimes government may give some duty drawback, like tax, whatever is levied, they took it back. Waiver, okay, no need to pay tax. Some cash incentives, concessions, reimbursement of some amount. When you spent, government will later on give it back to you. Like that, so many ways the government gives subsidy. It's not in the just name of subsidy. Name can be different. It can be subsidy, it can be grant, it can be some cash incentive, it can be duty drawback, it can be waiver, it can be concession, it can be reimbursement, anything. Okay. Now, who will give? Central government may give, state government may give. Like many years back, when Tata company wanted to set up nano plant, many years back, it went to West Bengal. But at that time, West Bengal government or the people did not support. But one simple message came from the Chief Minister of Gujarat, Narendra Modi, welcome. And Tata plant was set up in Gujarat. So they support the businessmen, they grow. These people don't support, they live poor. That's it. Okay. Now let's understand that central government, state government, or जल्दी से बोलो मेरे को. Yes, any agency may be there, authority may be there, a body which is created by the government may give subsidy to businessmen or even to charitable institutions. and subsidies are most of the time not taxable, right? Subsidies are not taxable. Suppose government gives subsidy to purchase an asset, then whatever subsidy government gave, that will be reduced from the cost. Suppose 300 crores worth machinery Adani has to purchase. Adani spent 300, purchased the machine. Now government said 100 crores will give reimbursement to you. Now in books of accounts of Adani, will he write 300 crores or he will write 200 crores? The answer is 300 minus subsidy of 100. So 200 only he can write it in books of accounts. Okay, this is how things work. And let's go to the last thing. In income, it can be any support to any institution of government for any purpose. Then such type of support for a social cause is not at all taxable. Okay, very good. LPG subsidy also everybody is getting, correct? So many subsidies government give. So subsidies are mostly not taxable. Some rare cases it would be taxable. Case to case we'll discuss. Now, heads of income, I already said to you, section 14, that there are 5 heads of income. Let me tell with you a story. Once you qualify CMA, what will you do? Sir, we'll go to a job. What will you get? Salary, correct? So first head is income from salary. Now, when you regularly get salary, what will you do? Sir, I want to purchase a house. One flat I want to stay, one I want to give it on rent. Very good. So you started getting rental income, and that is taxable under income from house property. You may be fed up after some time. You want to do some business. I want to set up my own practice. So when you do business, you get profit. When you set up practice, you get some fees. And that is taxable under the head income from profits and gains of business or profession. Then when you create multiple properties, you will sell and earn income. When you sell and earn income, that is income from capital gains. Or you want to become a stock market trader. Trading is bad. Investment is great. Right? Become an investor. Do fundamental analysis. Invest in right companies. Let your money grow and your mental peace remain. Right? When you are into trading, neither your mental peace nor your money will stay. Both will go. Please understand. Okay. Let me continue with the story. So what I was telling, you became an investor in shares. So you were selling after some time and earning money. And that is income from capital gain. Any other income, whether it is interest income, dividend income, right? Or you may get something like lottery, casual incomes, all that is taxable under income from other sources. Tell me how many heads are there? 5 heads of income. What are they? Income from salary, income from house property, income from profits and gains of business or profession, income from capital gains, income from other sources. Now, when you file your income tax return, you go to incometax.gov.in website, and then you will go to the returns dashboard, because every year you have to file the details of your income, correct? Now you will put correct income in the correct head. Salary income should be in salary head only. House property income should be, rental income should be in house property only. If you win lottery, it cannot go in salary. It will go in income from other sources only. So like that, putting your income in the right head is important. And that's why we are discussing this subject, na, income tax. As a professional, you will help your clients to do the same. Even if you join a job, you can file income tax returns for many people, correct? And you can generate income. Yearly one-time activity. You are habituated, you can do regularly. So learn this subject. Additional income आता है यार, along with job. Very good. So what I was telling, classifying is very important because every head, if you properly put the income, there are some related deductions. So you can get that deductions also. But if you don't classify the income correctly, don't put the income in correct head, then you may miss out on the deductions which you could have got. Okay. Suppose example, you earned some interest income. You put it in salary head. What will happen? Nothing. To earn the interest, you would have paid something that also you cannot claim. So like that, there are so many things which I suppose rent is there. You earn rental income. You put it in salary. What will happen? Now you earned rent, but for maintenance, for interest on loan to construct the house, such deductions you have to claim, correct? You did not just get income. There are some related expenses for that. You should be able to claim. And for that purpose, put your income under right head. Okay? Very good. Now, I want to tell you that 5 heads we discussed. First 4 heads are very specific. That means specific income is only taxable in that head. Like to tax it under salary, there must be some employer, there must be some employee, and the employee should get salary. Then only it's taxable under salary chapter. Similarly, house property has rules, business and profession has rules, capital gains have rules. But if suppose an income don't fall under these 4 heads, then where it should be kept? It is taxable under income from other sources. It is taxable under income from other sources. So we call this head as residuary head. We call this as which head? Residuary head. So any income which is not taxed under the 4 heads is taxable under income from other sources. Okay. But there is a word called as source of income. And just now we discussed a head of income. Is there any difference? Yes, there is a difference. Heads are 5, right? But sources can be many. Under same head, there can be multiple sources. Like example, income from house property, I said. Income from house property may have house 1, house 2, house 3, house 4. So 4 different sources. But all will come under income from house property only. Income which you generate from business and profession head, you can have multiple businesses, correct? So if you have multiple businesses, there are multiple sources. But all will be taxed under which head? Profits and gains of business or profession. Like take the example of Mr. Mukesh Ambani ji. He has Reliance Industries, he has Reliance Retail, he has Reliance uh, telecommunications business also, right? So when we think about so many businesses which he has, all these are sources for him, correct? But head, profits and gains of business and profession, only one. Okay, this is how we should understand the topic. Now let's go to the next topic, and that is gross total income. How to compute? Now we understood 5 heads, correct? So when we do the total of these 5 heads, right, income from salary plus house property plus business and profession plus capital gain plus other sources, we get something called as gross total income. When income from salary plus income from house property plus income from business and profession plus capital gains plus other sources, we get gross salary. Oh, gross total income. What will we get? Gross total income. What we will get? Gross total income. From this gross total income, we will deduct deductions under section 80C to 80U. Now, what are these deductions? If you do some investment, if you do some savings, if you incur certain expenditure, if you earn some income. Oh my God, I used 4 words, correct? Investment, expenditure, income, correct? Or savings. If you do something which is specifically mentioned under 80C to 80U in relation to investment, in relation to expenditure, savings, or your income generation, then you will get deductions under 80C to 80U. You will get deductions under 80C to 80U. Okay. So from your gross total income, when you deduct deductions from 80C to 80U, then you get total income. Now, what should we do with this total income? We should first round it off under section 288A. What we are supposed to do? Round off. Under which section? 288A. How will we do? To the nearest 10 rupees. Suppose you prepared your business income computation under income tax or total income computation under income tax, and when you found out the total income, it was suppose 104 rupees. Just for example. So round it off to the nearest 10 rupee. So what is the nearest 10 rupee to 104 rupees? 100. So 100 is your income. Suppose your income is 105. Then take 110 as your income. If it is 107, take 110. If it is 109, nearest 10 rupees 110. If it is 101 rupees, 100 is your nearest income. Okay. So your income, that is total income, should be rounded off under section 288A to the nearest 10 rupee. Similarly, your tax should also be rounded off to the nearest 10 rupee under section 288B. 288B for Bombay. Okay. So under section 288B, your tax should also be rounded off. This way you should remember the entire topic. Now, next topic. We'll go to something called as 10 steps. Whole income tax is covered here in these 10 steps. So listen carefully. You will understand a little now, but you will understand by the end of the whole subject. And later on when you see, this is picture lighter away. Very easy. You will feel. Okay. But as of now, this may seem to be tough. Right? Listen, simple. First is determine the residential status. What does this mean? If you stay in India, you will be taxed differently. If you stay outside India, you will be taxed differently. Correct? So, where you stay actually matters a lot. So, first step is to determine residential status. And this we'll do in chapter 2. Okay? Now, come to step 2. Second step says that compute your income under various heads. Like I just explained to you now, there is income from salary, income from house property, income from profits and gains of business or profession, income from capital gains, income from other sources. So from various heads, you will earn income. That income you should compute. This is step 2. Once you complete this, then you have to do gross total income. Aggregation, we use the word. That means salary plus house property plus PGVP plus capital gain plus other sources. Gross total income. Once you do this, you have to deduct deductions under section 80C to 80U. Once you do this, you will get total income. Correct? Which we just saw in the last page now. Same is explained here. Once you do get the total income, you have to round it off to the nearest 10 rupee under section 288A. Just now I taught, na? Same thing. Now, once you complete this rounding off, you have to calculate the tax on it, which we will discuss in the next videos in this chapter itself. Okay? Dekho, in income tax, it's not enough if you compute your income. You should also calculate tax. So tax will be calculated. But if you just calculate the tax, it's not enough. Sometimes you get discount also. We call it as rebate. So if suppose you are eligible for discount, will you claim the discount in tax? The answer is yes, obviously, sir. If I am getting discount, who will leave? So that discount is called as rebate. So deduct the rebate also, if you can get, if you are eligible to get. Then suppose you are a super income earner, then there will be tax on tax, and that we call it as surcharge. That we call it as what? Surcharge. What is surcharge? It's a tax on tax. So that surcharge should be added. And suppose after adding surcharge, after computing tax and if applicable added surcharge, then last two steps we have to discuss. And that is one, adding health and education cess. What we have to do? Add health and education cess. Once you add this health and education cess, you get your tax payable. But is it over? No. You have to round off the tax also, I said, na? According to section 288B, rounding up of tax to the nearest 10 rupee. That you will do in the last step. Like that, whole income computation happens. Again, I'll repeat for you. First, we compute, decide residential status. Then compute the income under various heads. Then do the total of all heads, get gross total income. Then deduct deductions under ATC to you. Then get the total income. Round it off to nearest 10 rupee and then calculate tax on it. After calculating tax, deduct rebate if it is applicable, or if you are super income earner, add surcharge to it. And after that, obviously you will add health and education cess. And finally, when you get the tax, round it off under 288B to the nearest 10 rupee. Now, these steps no need to memorize. This is general knowledge for all of you. Okay? When we go with each and every chapter slowly, you'll automatically remember this. There is no requirement to remember. Moreover, this is general knowledge. Even in the exams also, they will not ask. And once you complete income tax, if it is asked in exam, you will laugh and you will write it. Okay? Arey bachcha question puch liya. Like that you will feel. Okay? Now, let's come to some complicated topic, which I will make easy for you. Right? There is something called as tax planning, tax evasion, tax avoidance, and tax management. Oh, four words, very important words. Tax planning, tax avoidance, tax evasion, tax management. What are the four words? Tax planning, tax avoidance, tax management, tax evasion. Correct? Let's understand each word in detail. Because general knowledge I'll give on this topic. It's not asked in exams, but knowledge is important for you. Okay? And if it is asked in exam also, if you write 3 points also, that's more than enough. Maybe asked in differences for 4 marks. That too, maybe in 5 years they may ask one time, or maybe in 10 years they will ask one time. They may ask differences. Right? What is the difference between tax planning and tax evasion? Like that, once in 5 years they may ask. If you are good with 3-4 points, that's more than enough. So I'll give understanding to you. That's it. Okay, let's continue. What is tax planning? Basically, you want to save tax, correct? You want to pay more tax or you want to save tax? Come on, answer. Obviously, you want to save tax. You want to reduce the tax. If you reduce the tax by following the provisions in the act, when I say act, it is Income Tax Act. So if you follow the provisions of Income Tax Act and save the tax, like I said, discount, rebate, I said deductions, 80C to 80U deductions, I said, right? So like that, some benefits are given in the law itself. If you use it properly and save tax, reduce tax, that is tax planning. But suppose if you find the loopholes in tax law, right? Because law is made by people, correct? It is not always 100% perfect. There may be some loopholes. So if you use the loopholes in the tax law and try to save the tax, then that is tax avoidance. So tax avoidance is, you will use the loopholes, you will use the limitations in the law to save the tax. Okay. Now, third is tax evasion. Here, you want to totally evade the tax. Don't pay the tax. So you will either suppress the sales, that means don't show sales revenue, or you will increase the expenditure by showing dummy invoices, dummy bills, nakli bills, and then you try to show more expenditure and less income. Income you are not showing, expenditure you are showing more, which is actually not there. Then this is called as tax evasion. Okay, very good. Tax management. Tax management is basically trying to do tax planning or doing right things at the right time. Like example, there is an income tax calendar. You have to follow the calendar. So following the calendar of income tax, doing things right so that you can avoid the interest, avoid the penalties, right? Properly save the tax. So this is tax management. So it is mostly a compliance part. It is mostly a procedural part which you do with discipline to save the tax. And that is tax management. Okay. So basically tax planning is simply, come on, yeah. Tax planning is simply reducing the tax by using the provisions of law. Tax avoidance is basically reducing the tax but using the loopholes. Tax evasion is doing some illegal activity, right? By showing nakli invoices, right, of expenditure, suppressing the sales to reduce the tax. Tax management is properly following the tax laws with discipline on timely basis, doing compliances, following the procedures. Okay. Now, there are two terms which I'll coin for you: script and moral. What are the two words I said? Script and moral. Script is basically law and moral is basically ethics. So in tax planning, it is right as per script and right as per moral. So legally, morally, tax planning is right. Whereas tax avoidance, it is legally right because you used loopholes. But morally, it is wrong. Right? Tax avoidance, legally you are right, but morally you are wrong. Tax evasion, you are legally wrong, morally also wrong. Okay? And tax management, you are legally right, morally right, like tax planning. Okay? So tax planning, legally, morally right. Tax avoidance, legally right, but morally wrong. And in tax evasion, both way you are wrong. Right? Understood? Very good. Tax planning is long-term initiative. So it will be advantageous for you in long term, and you will not face any tax complications also with the department. So in long term, it is beneficial. You will get the trust of the government, you will get the trust of the banks with tax planning, because you are a law complier. That means you comply with the law. So it is beneficial in the long run. Tax avoidance is just a short run benefit, because tomorrow government understood the loophole and covered it. Then will you be able to avoid? The answer is no. So that's why tax avoidance is short term. Then if you think about tax evasion, it is illegal, it is punishable, right? You may have to face legal complications, right? Prosecution, sometimes even you may have to go to jail. And tax management is all doing things at the right time. It is all administration type of thing. We can say tax management is tax administration, doing things on right time. Okay, this way you should understand. And tax management, like tax planning, is beneficial in the long run, right? It is basically a continuous process which will benefit you in the long run. This you should understand. Basically, I'll tell you that tax planning is desirable. You do. Government also says, very good, come on, continue. You can do tax planning. So it is desirable. Tax avoidance, if you do, government may not punish you, but please avoid. Okay? So tax avoidance should be avoided. Okay? Similarly, tax evasion, it is objectionable. Government will have objection. Government will become serious. Income tax authorities may raid your premises. Search seizure may happen on your premises. Right? You may have to pay heavy taxes which may go up to 100% of your income. If you are caught in tax evasion, you may have to go to jail for so many years. Right? So it is objectionable. And last one, tax management, it is essential. You do, it is better. Essential. So tax planning is desirable, tax avoidance is avoidable, tax evasion is illegal, and tax management is essential. Similarly, tax planning is moral. Tax planning is moral. It's moral, you do. Tax avoidance is immoral, unethical. Okay. Tax evasion is obviously illegal here, right? And finally, tax management, it's your duty, right? To follow the calendar of income tax. So it is duty oriented. It is administration oriented. Okay. So this way you should be able to write the differences. You should be able to write the definition. You should be able to write the features. You should be able to write what is the purpose, object, beneficial or not, right? Moral, ethical or not, right? How much term you will get benefit. So many things are there. You should be able to write at least 3 4. If you are able to write, that's more than enough. Okay, let's come to the last topic of this lecture, and that is application of income and diversion of income. Tell me, when I talk about diversion of income, will you, okay, application I'll tell easily first. For you, you will understand also. Application is spending the money. So you get salary. When you get salary, you go to a grocery store and purchase some groceries. That is application. Now I'll tell you, you got 1 lakh salary. So yearly 12 lakhs. You said that, sir, I already spent 6 lakhs rupees. So I spent personal expenditure of traveling expenditure, family expenditure. So I'll not pay tax on that expenditure part. Only leftover money I'll pay tax. Will government agree? So even if you apply the income, or don't apply the income. You earn the income, it is taxable. So application will not stop the income tax department from taxing you, because income tax is on income earned. And after earning the income, if you apply, tax department will not say that okay, you applied, will not tax. They will say you earned income, you pay the tax. And application means spending the income. Okay. Diversion, देखो, application when you can do, first you should get, then you can spend, correct? Diversion is different. Diversion is you don't get the income itself. Suppose example, you have to receive some money, but what you did not receive, but you asked the payer to pay it to some other person. It happens, na? In friendship also it happens, business also it happens. Now, it is actually your income, but you divert it to some other person. So did you receive it? No. So when you did not receive, will you pay tax on it? Obviously, you will not pay tax on it. So if the income is diverted, you will not pay tax on it. But who will pay tax? The person who actually received it. Okay? Very good. In partnership, there was a concept actually. 3 partners were there. They were doing partnership business. But in the partnership deed, one term was there, that partner C will involve in partnership activity, but the profit should be given not to C, but maybe to C's father. Okay. So did C get the money? No. Before he gets only, his father got it. So if it is diverted like this, will C pay tax or his father pay the tax? The answer is who got it will pay the tax. So his father got the income, his father should pay the tax. And that's what diversion of income. Okay. So we discussed so many concepts today. Long video, correct? So we discussed income under section 2 clause 24. Then we discussed heads of income section 14. We discussed sources of income. We discussed gross total income 80B subsection 5. We discussed rounding up of income under section 288A, rounding up of tax 288B. We discussed 10 steps which we'll learn throughout the income tax chapter, and then so that tax can be computed, income can be computed. And we discussed tax planning, tax avoidance, tax evasion, tax management, and finally diversion of income and application of income. So we completed all these concepts. So just read through everything. You'll get ultimate confidence, and we'll meet in the next video discussing the tax rates. So next video would be exciting, interesting. Just follow us. Okay. Bye everybody.